Hi everyone. In today's class, we are going to be dissecting non-discounted cash flow method of project evaluation. We have discussed so far net present value, internal rate of return, areas of conflicts between the NPV and the internal rate of return. We also discussed discounted payback period and finally modified internal rate of return under the um, discounted cash flow method. So today we are going to be discussing concepts around the payback period and the accounting rate of return. Thereafter, we'll move to discussing relevant cash flows. So let's take it one after the other. What do you understand by payback period? The payback period simply means the period, usually expressed in years, in which it takes cash inflow to equate cash outflow in capital investment. The payback period is a measure of liquidity. That is, how quickly can a company recover or recoup the amount invested in a project. Therefore, payback period is a measure of liquidity because the focus of management is the recovery of their initial investment. So, payback period measures liquidity of a project. So, in the calculation of payback period, cash flow must be used because of all investment appraisal techniques, apart from the accounting rate of return, all the techniques make use of cash flows. It is only accounting rate of return that uses accounting profit or loss. So if accounting profit or loss are given, it should be converted to cash flow before calculating the payback period. Therefore, how do you convert accounting profits or loss to cash flow? So the cash flow is simply the summation of accounting profit or loss and the depreciation. That is, whenever you want to calculate payback period, or you want to calculate NPV or the internal rate of return, any techniques, and you are given accounting profit or loss, so the most important thing you need to do is to add the accounting profit or loss, add it to depreciation. Okay, that accounting profit or loss plus depreciation will give you cash flow. All right, please watch out for that. All right, and then especially when you see questions under the non-discounted cash flow method, maybe you have to calculate payback period or accounting rate of return. Please pay particular attention to the information, to the numbers given to you, because at times, if examiner wants you to calculate payback period, you may be given accounting profit or loss, which of course that will not be suitable for calculating payback. So what that means is that you need to convert the accounting profit or loss to cash flow. Again, if you're asked to calculate accounting rate of return, in most cases, you may be given cash flows. So if you are given cash flows, you are expected to convert it to accounting profit or loss before computing the um, accounting rate of return. So when we get to ARR, accounting rate of return, I will explain that so that it will be clearer. All right. So that's that. Now, the advantages and disadvantages of payback period is something you can just go through the material, you get it. Therefore, in the calculation of payback period, how do you calculate payback period? You can, when calculating the payback period, you can either use formula or you use tabular method. Whichever of the two that you use, you are going to get the same answer. Especially the formula is used when you are given constant cash inflow. Okay, when you are given constant cash inflow, then the payback period is the ratio of cash outflow to the constant cash inflow. All right, when you are given constant cash inflow, then payback period represents the ratio of cash outflow to the constant or regular cash inflow. All right. So this is the formula you are expected to use where you are given constant cash inflow. What do I mean by constant cash inflow? If the cash flow, say for example, a project that has 5 years life, the useful life of the project is 5 years, and you are told that the project will generate annual cash inflows of 50,000 naira. Okay, the project will generate annual cash inflow of 50,000 naira for the next 5 years. So what that simply means is that every year it will be 50,000 naira cash inflow. Year one, 50,000. Year two, 50,000. Up to year five, 50,000. So because the cash inflow is constant, so you are not expected to use the tabular method because the formula will be faster. Just divide the initial outlay with a constant cash inflow, you get your payback period. So this formula is the most suitable. If you use the tabular method, you get the same answer, but this formula is faster. However, when you are given non-constant or irregular cash inflows, you are expected to use tabular method. So as a result, you are going to use this table. And in this table, what we are trying to do is to recover the initial investment from the cash flow generated by the project. Let's look at these hypothetical figures. When you want to calculate the payback period, of course, you are going to create like 4 columns, like as you have on the screen. So the first column is the number of years, the description of items, cash flows, and then balance or cumulative. Now, remember, we want to recover the initial investment. So in these numbers, our initial investment is 100,000. So at year zero, it's still the same 100,000 naira balance. So to recover this, I will bring out my calculator to say 100,000 naira minus the cash inflow in year one of 40,000. That's 60,000. Which this simply means is that at the end of year one, the company has recovered 40,000 naira out of the initial investment of 100,000. So we have a balance of 60,000 naira. I will then move to the following year. The next year, cash inflow is 70,000. However, the outstanding balance is less than the cash inflow of the following year. Therefore, you put a dash. This is because once the outstanding balance is lower than the next cash inflow, you need to put a dash, put a stop, then you calculate your payback period. So as a result, how many years have we recovered? We have recovered 40,000 naira in year one. Therefore, to calculate my payback period, I would then say year one, I've recovered 1 year plus the outstanding balance of 60,000 divided by the next cash inflow of 70,000. That's what produced 1.9 years, which means that this project will recover initial investment of 100,000 naira within the next 2 years. Okay, the project will recover the initial investment of 100,000 within the next 2 years. So that is how to calculate payback period. Therefore, what are the decision rules under payback period? For independent projects, accept if payback is shorter or equal to management predetermined payback period. I repeat, for independent projects, accept if payback is shorter or equal to management predetermined payback period. So independent project, like I explained in our previous class, is a standalone project that may be accepted or rejected based on its own merit. So it's a singular project. So if that project has a lower or shorter payback period, okay, or equal to the management predetermined payback, then the project will be accepted. However, where there are mutually exclusive projects, you accept any project with a shorter payback period, provided it is lower or equal to the management predetermined payback period. So what that simply means is that for the acceptability of a project using payback period, you are expected to benchmark the calculated payback period with the management intended or targeted or predetermined payback period. So your calculated payback period should be benchmarked against the management intended payback period. So please watch out for that. All right. So at this point, for the acceptability of the project, the calculated payback period is not benchmarked against the against the project useful life. All right. You don't compare the calculated payback period with the useful life of a project. It has to be compared with the management predetermined payback period. Hence, in determining the financial viability of a project using payback period, the calculated payback period is benchmarked against the management targeted payback period for the acceptability of the project. This means that if the predetermined payback period is not available, there will be no basis for the acceptability of the project. Oftentimes, examiner may want you to advise on whether the project should be accepted or not. So what this is simply saying is that if the management targeted payback period is not given to you, there will be no basis for the acceptability of the project, because you cannot compare your calculated payback period with the useful life of the project. That's not what you should do. It has to be benchmarked against the management intended payback period. All right. So again, if in that question, examiner is now asking you to advise and you are not given management predetermined payback period, what you are expected to say is that the project will pay back the initial investment within 2 years, within 3 years, whatever you have computed. So just mention it. However, the acceptability of the project may not be possible because the management predetermined payback period is not provided. But if you are given the management intended payback period, you need to compare with your calculated payback period. So that's the decision rule for payback period. Now let's have a simple illustrations to demonstrate the two, where you have constant cash inflows and the non-constant cash inflow. Let's see how you are going to compute it. Whether you have a very voluminous illustration, maybe 2 pages, 3 pages, is the same principle. All right, is the same principle. Therefore, let's use this example to demonstrate how to calculate payback period. Africana Limited is considering a project that requires a cash outlay of 250,000 naira and generates a net cash flows of 100,000 naira per year for the next 4 years. So I can see initial investments, initial outlay to be 250,000 naira. I can also see examiner has told me net cash flows of 100,000. In this case, I can see cash inflows. Okay, I can see cash inflows of 100,000 naira. However, the management of the company has set the maximum acceptable period of 2.5 years for the project to recover the initial investment. So here, this 2.5 million is the management targeted payback period. That's the targeted payback period. So what this simply means is that once I calculate my payback period, I need to compare with this management intended payback period. So required, calculate the project's payback period and advise whether it should be accepted or not. Okay, so examiner is asking us to advise whether this project should be accepted or not using payback period. So what am I supposed to do? This is very straightforward kind of a question, because examiner has made life so easy to me, so easy for me by giving me the constant cash inflow of 100,000. Initial investment is 250,000. Constant cash inflow is 100,000. Remember, I mentioned that payback period, where you are given regular cash inflow, payback period is computed as the ratio of cash outflow to cash inflow. That is, just divide the 250,000 by 100,000. That will give me 2.5. All right. So let's work it out. So see our solution here. Since there is a constant cash inflow of 100,000 naira from the project, therefore, payback period will be computed as follows. Cash outflow divided by cash inflow. So that's the formula you are expected to use because examiner has given us a constant cash inflow of 100,000 naira. Therefore, payback period is 250,000 divided by 100,000 naira. That's 2.5 years, which means that this project will pay back within 3 years. This project will pay back within 3 years. So I need to advise. Examiner is asking us to advise whether the project should be accepted or not. So the project's payback period is 2.5 years. Since the management predetermined payback period of 2.5 years equal to the project's payback period, the project should be undertaken. Remember, our decision rule is that for a single project, okay, for independent project, we said that payback period, the project should be accepted if the calculated payback period is shorter or equal to the management predetermined payback period. Since the management predetermined payback period is 2.5 years, then our calculated payback period is also 2.5 years. It means that the project is financially viable and should be undertaken. That's all. It's as simple as that. So let's have another example. Okay. Now, this example 2 involves a situation whereby you are given different numbers for each year, different cash flow for each year. Okay, so yes, Johnson Limited is currently considering two mutually exclusive investment projects. Both projects are concerned with the purchase of a new plant. The company made available the following data for the project. So we have project A, we also have project B. Cost, that is immediate outlay, 200,000 naira. So initial outlay of projects A and B are given here. Expected annual profit or loss for year 1, year 2, and year 3. We're also given the expected residual value. The company has an estimated cost of capital of 10% and employ the straight line method of depreciation for all fixed assets when calculating net profit. So I don't need cost of capital for anything when I'm calculating payback period. All right. Therefore, that information of cost of capital is irrelevant. I only need cost of capital if I want to discount the project to the present value equivalent. If I want to discount the cash flow to the present value equivalent, rather. So the company has sufficient funds to meet all capital expenditure requirements, okay, required. Calculate the payback period for each project and advise which of the two projects are to be selected. Like I mentioned when I was explaining the concept on payback period, you have to be very careful on the numbers given to you. When you look at these numbers from year 1 to year 3, 58,000 for project A, 36,000 for project B. In year 2, negative 2,000, negative 4,000 for project A and B, then 4,000, 8,000 for A and B respectively. These are, you remember when you want to calculate payback period, you need cash flows. It is only the accounting rate of return that makes use of accounting profit or loss. Therefore, when you look at the figures given to you here, examiner has mentioned that expected annual profit or loss. So you have been given profit or these are not cash flows. All these numbers are not cash flow. They are profit or loss. And you don't use profit or loss to compute payback period. It has to be cash flow. So as a result, you need to go and convert the the accounting profit or loss to cash flow. To get the cash flow, of course, like I explained earlier, cash flow is equal to accounting profit, okay, accounting profit or loss plus depreciation. That will give us the cash flow. So let's quickly solve the question, all right, and move to the next one. So from the question given above, annual accounting profit or loss were provided. Since payback period makes use of cash flow, I think I've already explained this, and I've also shown you how to convert accounting profit to cash flow. So from this formula I just gave here, you will notice that we need depreciation. So the first working that you are going to do should be depreciation. You need to calculate annual depreciation. Once you have the annual depreciation, you add it to the profit or loss to get your cash flow. So let's quickly do that. All right. So annual depreciation is computed, okay? Annual depreciation is computed as initial cost of the project minus scrap value divided by the useful life of the project. So in this question for project A, initial outlay of project A is 200,000 naira, okay? It's 200,000 naira. Initial outlay of project B is 120,000 naira. Okay, it's 120,000 naira. So let's go ahead. 200,000. How much is initial outlay of project A? Initial outlay of project A, residual value of project A is 14,000. Residual value of project B is 12,000. So you now less 200,000 minus 14,000 divided by the useful life. Okay, that's what produced the 62,000. Again, for project B, initial outlay is 120, scrap value is 12,000, useful life is 3 years, then annual depreciation is 36,000. Now that I have the annual depreciation, I need to compute my cash flows. Therefore, cash flow is equal to accounting profit plus annual depreciation. Then I will create a column. It is better for you to create a table for you to be able to do this. You are going to appreciate it. All right. So the accounting profit given to me for project A, the profit or loss given to me is 58,000 minus 2,000, then 4,000. The annual depreciation of project A is 62,000 naira. So every year 62,000. All right. So for me to now get the cash flow, accounting profit or loss plus depreciation will give me cash flow. That's why you have 120,000 in the first year, minus 2,000 plus 62,000 will give us 60,000. 4,000 plus 62 will give us 66,000. These are the cash flows that I need to calculate. These are the cash flow I need to calculate my payback period. I will do the same thing for project B. Accounting profit or loss for the first year is 36,000. Depreciation of project B, annual depreciation is 36,000. Okay, therefore, I will add together 36 plus 36 will give me 72 minus 4,000 plus 36 will give me 32,000. Okay, 8,000 plus 36,000 will give me 44,000. Now that I have cash flows, I've computed cash flows for both project A and B, I need to then proceed to calculating the payback period. Because as you can see, the cash inflows for both project A and B are irregular. In year one, our cash flow of project A is 120, year two 60,000, year three 66,000. The same thing with project B. In year one, cash flow 72, year two 32, year three 44. So these are irregular or non-constant cash flows. In that case, I need to use the tabular method to compute the payback period. All right. So if that is the case, I will then create a column, a table like we did in the explanation. All right. So initial outlay, this is for project A. Initial outlay is 200,000 at year one and year zero. So at the end of that year zero is still the same 200,000. So cash inflow of project A for year one is 120. Therefore, 200,000 minus 120, that will produce a balance of 80,000 naira after the first year recovery. Okay, so out of the 200,000 naira, the company has recovered 120,000 naira, remain balance of 80,000. I will then move to the next one. 80,000 minus 60,000, that will produce a balance of 20,000. So this company has recovered 180,000 naira out of the 200,000. So at the end of year two, the balance to recover is 20,000 naira. Therefore, Now, the outstanding balance of 20,000 at the end of year 2 is lower than the next cash inflow at year 3. So for this purpose, I will just put a dash, then I will calculate the payback period. So I need to ask, how many years have I recovered out of the 200,000? I've recovered the first one, I've recovered the second year. So that's why you are seeing 2 here. Then plus the outstanding balance of 20,000 naira divided by the next cash inflow of 66,000. This is what produced. I'll just carry my calculator. 20,000 divided by 66. Okay, 20,000 divided by 66. That produce 0.3. Then plus 2 years. That's 2.3 years. That's why you are seeing the 2.3 years here. All right. So that's that. They will do for project B. To do the same thing for project B, initial outlay of project B is 120. Okay, the balance at that year is 0. So 120 minus 72,000 will give us 48,000 at the end of year 1. I'll move to year 2. 48,000 minus 32,000. That's 16,000 balance at the end of year 2. Again, I'm supposed to go to year 3 now to recover the balance of 16,000. However, the outstanding balance is lower than the next cash inflow. Therefore, I will put a dash and I will calculate my payback period. Okay, how many years have I recovered? For project B, I've recovered year 1, I've also recovered year 2. Therefore, you have 2 plus the outstanding balance of 16,000 divided by the next cash inflow of 44,000. That is what produced 2.3 years, 2.36 years. Okay, approximately 2.4 years. Now, when you are given mutually exclusive project, it's important that you restrict your numbers to 2 decimal places, because if you round your number, the two of them can have the same number. You won't know which ones to choose, and that's why it is important you make it 2 decimal places, so that will be better. All right. So in the question, did the examiner ask us to advise? Let's go back to the requirement. Calculate the payback period for each project and advise which of the 2 projects to be selected. You will see that in this question, examiner did not tell us. We are not given the management predetermined payback period. Okay, you can see you are asked to advise which of the 2 projects to be selected. You don't know which is which because examiner did not tell you whether the project is financially viable. So you are not given the management predetermined payback period. So let's see our response, our advice. Okay. Project A has a shorter payback period of 2.3 years relative to the payback period of project B of 2.36 years. Therefore, project A is preferable to project B. Why? Because project A has a shorter payback period relative to project B. However, the acceptability and selection of project A will depend on the management's targeted payback period. Even though the examiner did not ask you whether the project should be accepted or not, you are only asked to advise which of the 2 projects to select, and that's why we selected project A, because project A has a shorter payback period. So if you are now asked to advise whether the project should be selected, should be accepted or not, then since you are not given management predetermined payback, there is no basis for the acceptability. So this is how to calculate payback period. So at this point, let's move to accounting rate of return. I've explained the concept of payback period, and we have used 2 examples to demonstrate the learning so far. So let's talk about accounting rate of return, which is the second technique under the non-discounted cash flow method of project evaluation. So what do you understand by accounting rate of return? The accounting rate of return represents a technique that relies heavily on the use of accounting profit or loss as shown in a company's financial statement. All right. The accounting rate of return is also known as return on capital employed or return on investment, and it measures profitability of a project. Okay, unlike payback period that measures liquidity of a project, the accounting rate of return measures profitability of a project. So if you are asked to calculate the accounting rate of return, you are expected to use accounting profit or loss. You don't use cash flow for calculating accounting rate of return. So what this simply means is that if you are given cash flows and you have to calculate accounting rate of return, you are expected to convert the cash flow to accounting profit or loss before computing your accounting rate of return. This is the same thing I told you under just the opposite of the information I gave to you under payback period, whereby you have to convert accounting profit or loss to cash flow. In this case, you are given a cash flow, so you need to convert it to accounting profit or loss. To do this, the accounting profit or loss will just be the difference between cash flows and then annual depreciation. Okay, cash flow minus depreciation will give you accounting profit or loss. Please do well to read the advantages and disadvantages of ARR. They are very straightforward. So how do you then calculate accounting rate of return? To calculate accounting rate of return, the first thing first that you need to do is to calculate annual depreciation. That's the first working that you are going to do. Calculate annual depreciation because you are going to need it, especially if you are given cash flow in the question. So the first thing first you are going to do is to calculate annual depreciation. I've done this previously under payback period. Annual depreciation is the initial cost of the project minus scrap value divided by the useful life of the project. Then the second thing that you are going to do is to calculate average annual profit. How do you calculate average annual profit? This is very important, especially where you are given cash flow. Therefore, the average annual profit, for you to be able to get the average annual profit, you must first of all determine total profit. Once you get the total profit, you divide it by the useful life. It will give you average annual profit. Therefore, how do you get the total profit? The total profit will be the cash flow of each year, okay, minus annual depreciation, of course, divided by the useful life, okay. So remember I told you that if you are given cash flow, you need to convert it to profit or loss. Therefore, cash flow minus depreciation will give you profit. So you add up all the profit for each year. Say, for example, the project has 3 years life. Year 1, year 2, year 3. Profit of project year 1, profit of year 2, profit of year 3. So you add all the 3 of them together. That will give you the total profit. Okay, that will give you the total profit. Once you have the total profit, you now divide it by useful life of the project. So that will give you average annual profit. So once you have the average annual profit, then you keep it on one side because the average annual profit is the numerator of your ARR. Then the next working you are going to do is to go ahead and calculate average investment. Okay, you go ahead and calculate average investment. How do you calculate average investment? Average investment is the initial cost of the project plus scrap value divided by 2. All right, because you added two variables together, that's why you are dividing it by 2. All right, so that will give you the average investment. All right, so once you have the average investment, then finally you need to go and calculate average annual profit. The average annual profit is the average annual the average rate of return, or accounting rate of return, is simply the average annual profit divided by average investment. Okay, average annual profit divided by average investment multiplied by 100%. It's a rate of return, so you have to multiply it by 100%. So that is how to calculate the accounting rate of return. What are the decision rules? Okay, what decision rule do you need to consider under accounting rate of return? For independent projects, accept if ARR, if accounting rate of return is greater than or equal to the management predetermined ARR. Then for mutually exclusive project, accept any project with a higher ARR provided it is greater than or equal to the management predetermined ARR. All right, so that is the decision rule. You should notice something here that under the non-discounted cash flow methods, both the payback period and accounting rate of return relies heavily on the management predetermined numbers. Okay, so what that simply means is that your calculated payback period or your calculated accounting rate of return should be compared with the management predetermined payback period or ARR. So that is the decision rule as far as the non-discounted cash flow methods are concerned. Now, let's have an example. Let's have an example to demonstrate what we have discussed so far as accounting rate of return is concerned. So example number 1, a company has a targeted rate of return of 22% and is now considering the purchase of an asset with the following information. Estimated profit before depreciation. Remember what I told you, always be careful on the numbers when you are calculating payback period and accounting rate of return. Always be careful on the cash flow or on the information on the figures given to you in the question. Okay, because you have to use the right figure. Now, these are the table given to us. These are the information relating to the project. So examiner is now asking you to calculate and advise on the acceptability of the project. You have to calculate ARR and advise on the acceptability of the project. So examiner says I should calculate ARR. What am I supposed to do? The first thing first, like I mentioned, the first working that you are going to do is to calculate annual depreciation. Okay, and you know that annual depreciation is the cost of the project minus the scrap value divided by the useful life of the project. Okay, now you keep it on one side. Then, of course, examiner has told us in this question that estimated profit before depreciation. Profit before depreciation is not the same thing as profit. Profit before depreciation simply means cash flow. These are cash flow. All these numbers are cash flow. They are profit before depreciation. All right. Remember, profit after depreciation is accounting profits. Profit before depreciation is cash flow. So in that case, since I want to calculate accounting rate of return, I have been given a cash flow. So I need to convert the cash flows to accounting profits, okay, to accounting profit or loss. So the first working that I will do is to calculate my annual depreciation, okay? So of course, annual depreciation, initial outlay of this project is 85,000. Okay, that's the initial outlay of the project, 85,000. Then the useful life of this project is 4 years. Scrap value is 2,000. Therefore, 85,000 minus 2,000 divided by 4. Okay, so that's what gave 20,750. Now that I've calculated annual depreciation, the next thing I need to do is to calculate annual accounting profit or loss. I need to calculate average accounting profit or loss. So for me to be able to do this, I need to less all the cash flow given to me. All this cash flow, 18,000, 25,000, 38,000, 45,000. I will less depreciation of 20,750. Whatever I have will be my profit or loss for each year. Then I will now sum everything together to get the total profit. Once I have the total profit, I will divide it by the useful life of 4 years. That will give me average annual profit. Okay? What information do I have here? The profits given is the profit given is profit before depreciation, which represent cash flows. Hence, the cash flows should be converted to accounting profit or loss by deducting annual depreciation from the cash flow to arrive at the accounting profit or loss. Okay, to do this, I will create 4 columns, one for the years, one for profit before depreciation, which is the cash flow. All these numbers are cash flows. These are cash flows. Okay. Now that we have the cash flow, we've already computed annual depreciation to be 20,750. Therefore, for me to be able to get profits after depreciation, which is the main profit, that we're supposed to use for calculating accounting rate of return. 18,000 minus 20,750 will give me 2,750. 25,000 minus 20,750 will produce 4,250. 38,000 minus 2750 will produce 17,250. 45,000 minus 2750 will produce 24,250. I will add up all the profit or loss, add everything together, and that's what produced the 43,000. So I need to calculate average annual profit. To get the average annual profit, the total profit of 43,000 will be divided by the useful life of 4 years. Okay, so that is what produced the 10,750. Average annual profit is 10,750. So the next thing I need to do now is to calculate average investment, and the average investment is initial outlay plus the scrap value divided by 2. The initial outlay of the project is 85,000 naira. Scrap value of the project is 2,000. 85 plus 2,000, that is 87,000. 87 divided by 2, that's what produced the 43,500. Finally, I need to calculate the accounting rate of return. And you know, accounting rate of return is average annual profit divided by average investment. I've already done the working. Average annual profit is 10,750. Average investment is 43,500. So divide the two. That's what produced 25%. Therefore, the project's accounting rate of return of 25,000. So I need to benchmark a calculated ARR of 25% with the management intended ARR of 22%, I think. Yes. So the management targeted ARR is 22%. So this project produced 25% ARR. We are given management targeted ARR. It means that the project is financially viable. Okay, so the project's ARR of 25% is higher than the management's targeted ARR of 22. Therefore, the project should be accepted. That's it. It's as simple as that. Okay, so let's have one more example for accounting rate of return before we move to the next one. All right, so let's use this example 2. And this example 2 is a question under payback period. Okay, Johnson Limited. In addition, that management's expected return on investment is 15%. So examiner has given to us the management targeted ARR of 15%. So our calculated ARR should be benchmarked with this 15%. So let's see what will happen. What is the question for Johnson? Let's go and check the question on Johnson. So examiner is asking us, we are referred to Johnson question under payback period. Where is Johnson question? Johnson. Yes, this is the question on Johnson. Look at, this is the question on Johnson. All right. This example number 2 is the question on Johnson. So in this question, examiner has already given to us accounting profit or loss. So I don't need to waste time. Since I've been given accounting profit or loss, all I need to do is to sum up. I will just say year 1, 58,000 for project A. Sorry, 58,000 profit plus minus 2,000 loss plus 4,000 profit. That's 60,000. The useful life of the project is 3 years. Therefore, average profit for project A is 20,000. I will then calculate average investment. Once I get average investment, then of course I will calculate my ARR. For project B, for example, 36,000 plus or minus 4,000 loss plus 8,000 profit. That's 40,000. So 40,000 divided by the useful life of 3 years. That's what produced 13,333. So that's that. So with this, let's quickly go and compute let's solve the question. Okay. Yeah. So notes. This is the solution. I provided notes. Since accounting profit or loss is given in the question, there is no need to calculate depreciation again. The profit or loss should be used directly to calculate the average annual profit, and that's what I did. You know, you sum up the 3 numbers. you get total profit of 60. You get total profit of 40, all right, for project A and B. Then you calculate average annual profit, okay, of 20,000, 13,333. So at this point, I need to go and calculate average investment. Average investment is initial outlay plus scrap value divided by 2. Initial outlay of project A is 200,000 according to the question. Scrap value of project A is 14,000. Therefore, 214,000 divided by 2 will give us 107,000 naira. For project B, initial outlay is 120,000. Scrap value is 12,000. That's 132,000 divided by 2. That's 66,000. Finally, I need to compute the accounting rate of return, which is average annual profit divided by average investment multiplied by 100%. So for project A, average annual profit is 20,000. Okay, 20,000. Average investment of project A is 107. Therefore, 20,000 divided by 107, that's what produced 18.7%, approximately 19%. For project B, average annual profit is 13,333. Average investment is 66,000. So 13,333 divided by 66,000 multiplied by 100% will give us 20.2, which is approximately 20%. Therefore, which of the two projects should we select, project A or project B? We said that the decision rule where there are mutually exclusive projects is that any project that produces a higher ARR, provided it is greater than or equal to the management predetermined ARR, should be undertaken. So project A and B produce an ARR that is greater than the management targeted ARR of 15%. The targeted ARR given to us in this question is 15%. And when you look at our calculation, both project A and B have ARR that is greater than the 15% targeted ARR. However, we have to select only one of the two projects because the company, it's a mutually exclusive. The company can only undertake one. Therefore, project B. All right. However, since project A and B are mutually exclusive, that is, competing project in which the acceptance of one will prevent the acceptance of the other, project B with a higher ARR should be selected. Okay. Project B with a higher ARR of 20% relative to project A with ARR of 19% should be accepted. So we are selecting project B because project B has a higher ARR relative to A of 19 ARR. All right. So that's the decision under accounting rate of return. So we are done with discussing non-discounted cash flow method. We have discussed so far the payback period and then the accounting rate of return concept. So the next thing we want to do to close the class is to explain relevant cash flows. All right, let's explain relevant cash flow. What do you understand by relevant cash flows? Because not all cash flows are relevant. So any cash flows that are directly attributable to the project under consideration are relevant. Any cash flows of receipt and payments, okay, any cash flow of receipt and payments associated with the project under consideration are relevant. Therefore, how do you identify relevant cash flows in a question? Because on the day of your exam, examiner will put in different kinds of cash flows, relevant and irrelevant. So you have responsibility to be able to identify which of those cash flows are relevant, which of them are not relevant. So I've taken my time to explain in details about 7 or 8 line items that you should look at that are very common in a question, which of how you are going to treat each of them. All right. So the first item is variable cost. What do you understand by variable cost? You all know that, like what you did in performance management, variable costs are costs that are directly that varies according to activity level. So the variable costs are relevant costs that vary according to activity level. That is, if the activity level changes, any increase or decrease in activity level will also affect the variable cost. For example, if your output, if your volume or units produced increase, then variable cost will increase. If the output decreases or decrease, then of course variable cost will also decrease. So which means that it varies based on activity level. Even though variable cost per unit is constant, it's not changing, but total variable cost will change depending on the activity level. All right. So whenever you see what are the examples of variable cost what are the examples of variable cost? One is direct material cost, direct labor cost, direct expenses, and then variable production overhead. Those are the four examples of variable cost. So when you see any of those four elements in a question, you should know that they are relevant. You have to account for them. Variable costs are relevant and should be undertaken when determining financial viability of a project. So the next item is fixed cost or fixed overhead. Fixed costs are costs that have no sympathy for activity level, meaning that irrespective of number of units produced, fixed cost does not change. Fixed cost will not change, does not change. It's the same thing, it's constant. So as a result, fixed cost is irrelevant, except it is incremental in nature. Okay, you only consider fixed cost if it is incremental in nature. However, there are three different ways in which examiner can test your understanding on fixed cost. There are three different ways, I repeat, there are three different ways in which examiner can test your understanding on fixed cost. The first one is that if you are given fixed cost, there is no further explanation, no additional information. You are just given fixed cost. Say, for example, fixed cost 1 million naira. If there is no further information, that fixed cost of 1 million naira is irrelevant. Just ignore it. Because fixed costs, provided the fixed cost will not change, so it is irrelevant, so you ignore. But if you are given fixed cost, including depreciation, in a scenario, examiner tells you that fixed cost, including depreciation. So what that simply means is the examiner wants you to do something. You need to go and calculate annual depreciation and less it from the fixed cost that include depreciation. So the difference is what is relevant that you are going to account for. I will repeat. If you are given fixed cost, including depreciation, it means that you have to do something. Meaning, you go and calculate annual depreciation and less it from the fixed cost that included depreciation. So the difference is relevant. You have to account for it. The third way in which fixed cost can be tested is that if you are given fixed cost excluding depreciation, fixed cost excluding depreciation is a relevant cost. You have to account for it, okay? Because the examiner has already removed depreciation. Therefore, what you have thereafter is relevant. You have to account for it. So that is the way to treat fixed cost when you see it in a question. So let's move to the next one. Incremental cash flow. All right. So when you talk about, at times you may be given incremental fixed cost, attributable, specific, direct fixed cost. So when you have all these kind of fixed costs, that means they are relevant. Okay, incremental, direct, attributable, or specific fixed costs are all relevant cash flows and should be considered when determining the financial viability of a project. Okay, so the next item that we want to discuss is depreciation, amortization, or provision. Okay, let's talk about depreciation, amortization, or provision. These are non-cash items and should be ignored. Okay, depreciation, amortization, or provision are non-cash item. All right, that is, they do not involve movement of cash. They are not cash item. For you to be able, when you are determining the financial viability of a project, cash flow is needed, and depreciation, amortization, or provision are not cash flow. Therefore, you ignore them. All right, because they do not involve movement of cash. So depreciation, amortization, provision are irrelevant and should be ignored. The next item is interest. Okay, the next item is interest. Interest is the actual amount paid on the loan borrowed. Okay, interest is the actual amount paid on the loan borrowed. It represents the compensation required by the surplus of debt capital from their investments. Okay, so it is the compensation for the use of funds for a specified future date. All right. Therefore, when you see the absolute amount of interest in a question, that interest amount is irrelevant. Say, for example, you are given interest of 50,000 naira. This is what is called absolute amount, or the naira amount of the interest. So this interest amount of 50,000 is irrelevant because the cost of capital to be used to discount the future cash flows already included interest. Remember, when we treated cost of capital, we mentioned that we calculated cost of equity, cost of preference share, then cost of debt. So the cost of debt already included interest because we use interest to compute the cost of debt for us to be able to calculate weighted average cost of capital. Therefore, if you now include the naira amount of interest, if you include the naira amount of interest in the determination of financial viability of a project, it means that you are double dipping. Okay, you are double dipping. That is, you are treating interest twice. It means that you are double dipping. So as a result, whenever you see interest in a question, you should ignore it because it is not relevant. It is not relevant. So the next thing we want to discuss is opportunity cost. Before opportunity cost, let's talk about sunk cost. Some costs are past costs. They are costs that have already been incurred and therefore irrelevant. So when you see any past costs in a question, please just ignore. It is not relevant. What are the examples of sunk costs? Examples include market survey cost, okay, research and development. You can be given development cost. When you see any preliminary expenses like feasibility study, okay, feasibility studies cost incurred, any costs that have been incurred before the project commence, irrespective of when the payment will be made, they are all irrelevant. They are sunk costs and therefore should be ignored. So past cost is not considered in the determination of financial viability of a project. All right. Okay, please ignore it. It is not relevant. Then let's talk about opportunity cost. Let's talk about opportunity cost. Opportunity costs are benefits forgone as a result of undertaking a particular course of action. Okay, opportunity costs are benefits forgone as a result of taking a particular course of action. All right, so opportunity cost is a relevant cash flow and should be considered. Anywhere you see opportunity cost is relevant and you have to account for it. For example, if a company wants to purchase an equipment and the company has an idle facility where they are going to install the, the equipment. Say, for example, there is a neighboring business that is willing to rent out, that is willing to rent the space. But because, and then of course, the neighboring business is willing to pay the amount for that storage facility, sorry, that idle facility. So the company will not be able to collect the rent because the equipment will be put in the idle facility, will be installed, the equipment will be installed in the idle facility. Therefore, the company will lose the benefit that would have accrued to it through the neighboring business. So that is what is called opportunity cost. All right. Say, for example, I'm a lecturer, I have a car. I can drive myself to the center. I can also use my car to do Uber service. So if I decided to drive the car to the center for me to be able to undertake my lectures, I won't be able to earn the benefit from Uber service. Therefore, if I want to determine my cost of lecturing, all right, the benefit that would have accrued to me through Uber service will be part of the cost of my lecturing. That is what is called opportunity cost. I believe that is clear. All right. So finally, let's talk about let's talk about working capital. Let's talk about working capital. All right. And then this is very common in a question, especially at this level. So what do you understand by working capital? Working capital represents the difference between, let me say, okay, I did not put it there. So working capital represents the difference between current asset and current liability. At times, examiner may not give to you the working capital itself. So you may need to go to the statement of financial position of the company and bring out the information there. And that's what I'm giving you this. So working capital represents the difference between current asset and current liability. Is the amount required for the day-to-day running of a business. Therefore, in the determination of relevant cash flows, working capital should be considered. So, for the purpose of capital budgeting, there is one-off working capital and then incremental working capital. So, you may be given a one-off working capital or incremental working capital. So for a one-off working capital, it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life of the project. For instance, a working capital that occurs in year 2 should be treated as cash outflow in year 1 and recover fully at the end of the useful life. This is what I'm trying to communicate. Say, for example, you are given a working capital of 5,000 naira in year 1. Okay, you are given a working capital of 5,000 naira in year 1. How do you then treat this? Say, for example, the useful life of this project is 3 years. Therefore, for me to treat this 5,000 working capital, I would create a column for year 0, year 1, year 2, year 3. Remember, this working capital occurs in year 1. Therefore, the rule says that you should treat the working capital as cash outflow in the year before the year of occurrence. Since the working capital occurred in year 1, occurred at the end of year 1, so you are going to treat it as year 0. So I will then come here 5,000. So that's the working capital. So it should be treated as cash outflow. So put it in bracket. In the year before the year of occurrence, then at the end of the useful life, you recover the entire working capital. The useful life of the project is 3 years. Therefore, at the end of year 3, I will recover the entire working capital. That means my working capital is equal to 0. By the time I discount it, it's not going to be the same thing again because discount factor at year 0 is different from discount factor at year 3. Okay, so this is how to treat working capital. Say, for example, you are told that this 5,000 working capital will occur at the end of the useful life of the project, that is year 3. It will occur at the end of year 3. How am I going to treat this? In this case, I would then say, since this working capital occur in year 3, therefore, year before year 3 is year 2. So the rule says it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. The useful life of this project is 3 years. So at the end of year 3, I will recover the entire working capital, which makes it equal to 0. I've recovered it. All right. So this is how to treat a one-off working capital. You can see it's only 5,000 naira. So it's one-off. It's only one time that it will appear. All right. That the company will incur it. So it will not reoccur again. So this is how to treat a one-off working capital. The second one is incremental working capital. So where there is incremental working capital, only the increments should be considered and the total working capital should then be recovered fully at the end of the useful life. So whenever there is incremental working capital, it should be treated the same way as a one-off working capital, except that only the increment should be considered. So say for example, you are given, let me look for a space. Okay, let me use it. Say for example, you are given a working capital, you are given working capital. Let me read. So you have year 1, year 2, year 3 for simplicity. So you are now given working capital of 1,000 in the first year, 1,200 in the second year, 1,500 in the third year. You will notice that the working capital has increased from 1,000 naira in year 1 to 1,500 in year 3. So as a result, I cannot use 1,000, 1, 2, and 1,500 to determine the financial viability, because the total working capital that I have is 1,500. All right. Therefore, what I need to do is to find the incremental working capital. Okay, let's say this is the total. I need to calculate incremental working capital. So I will then say incremental. Let me shift it. Incremental working capital. All right. So for me to get the incremental working capital, the working capital in year 1 is 1,000. From 1,000, it has increased to 1,002, difference of 200. From 1,2, it has increased to 1,5, difference of 300. Therefore, my total working capital, 1,2 plus 200, 1,000 plus 200 plus 300 will give us 1,500. Therefore, the next thing I need to do now is to go and post, to go and recognize the working capital. So what's the relevant year? So these are the working capital that I'm going to recognize in the books. Therefore, the rule says that the working capital should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life. So the working capital of 1,000 naira negative in year 1 should be treated as cash outflow in year 0. The working capital of 200 in year 2 should be treated as cash outflow in year 1. The working capital of 300 in year 3 should be treated as cash outflow in year 2. Then at the end of the useful life, I recover the entire working capital of 1,500. So these are the numbers I'm going to post in the determination of the financial viability of the project. So this is how to treat an incremental working capital. I think we are done with all the explanation of relevant cash flow. So take your time to review the material to gain more insight. All right. So in our next class, we are going to be doing impact of inflation and taxation in investment appraisal. All right. Thank you. That's the end of today's class.